Charlie Gasparino on the dangers of riding a puppy to the top and then seeing it reverse suddenly on you. The argument being that a lot of former presidents who've dealt with rising markets, from Bill Clinton to Ronald Reagan, they've quoted the economy or they've quoted jobs, but they hopefully, if it was a soaring market, they let that speak for itself.
Yeah, I mean, it was a fool's game. It's always a fool's game to hype a market. You know, when you see people walking around with Dow 25,000 hats, right, you want to say, take it off or turn backwards or something. You know what I'm saying?
Jinx, yeah.
It's a jinx. And, you know, here's the thing. The reason why the stock market has been up under Trump is the main reason is the economy. And the economy is getting better. The jobs are getting better.
That's what people relate.
But remember, markets correct. And markets correct based on a lot of different things. And they correct often when there's other more suitable investments to put your money in.
And they correct sometimes on good news.
Right. And here's why.
Right.
Because of inflation, bond prices are going down. And at some point, investors are going to start buying bonds to stop it from going. And then the prices will stop going down because they have a decent amount of yield.
We should explain, when bond prices go down, their yields go up. Right. That's what's been happening now, 4-year highs.
And so at some point, people are going to just keep selling stocks. And then they're going to put in cash, and then they're going to buy the bond because you will get a risk-free return from a bond.
But we have the added dimension, and you've reported on this as well, is they're issuing more Treasury notes and bonds right now. So now you got a supply issue, too.
The problem with figuring out this market is this, and this is where it gets really tricky for the average investor, where you probably shouldn't be in either the bond or the stock market right now, maybe in cash, or at least not doing anything, letting this settle out. Bond market, there's pressure in the bond market because the Fed is essentially unwinding its portfolio. It's tapering, right? Right. So you get pressure on, so prices go down, yields go up. On top of that, there's pressure on the market, on the bonds, because stocks are overvalued. People think there's inflation in stocks and in everything else. So again, bond prices go down when in an inflationary environment, yields go up. So both places, it's hard to put your money in because stocks, we're clearly in a correction or heading towards.
But what would prompt someone who's looking, let's say at a 3% 10-year note, it's 288, whatever it is right now. Would 3% be the inflection point, which you say, you know what? I'd rather get 3% guaranteed by Uncle Sam
on 10 years, on a 10-year bond.
Then God knows what in this volatile market.
It's only 3%. I mean,
see, that's what I'm saying. So you and I can remember when rates were a lot higher, but there are a lot of young folks we work with here who, for them, it's something altogether
new. And by the way,
new.
And maybe the inflation fears that you've seen in the market right now are overdone. We don't know.
Right.
That's why it's a big. This is a sorting out of the markets right now. And here's something else. Maybe the growth fears. A lot of people thinking that, you know, the corporate tax cut is not going to spur that much growth, that Trump's anti-trade stuff is going to hurt growth. Maybe he doesn't become protectionist. Maybe the trillions of dollars in fiscal stimulus through a massive tax cut will really help the economy, and you will get both low inflation, keep inflation sort of low, and you get corporate profits rising. That's a great time.
Well, that is a prevailing view that no less than the United Nations, no friend of Donald Trump, is estimating in a report released today that it's going to encourage $2 trillion to come back here. It's going to stimulate the U.S. economy. It's going to stimulate the world. The IMF, I think, said much the same when the president was in Davos. And we hear from all of these companies and your buddies like Jamie Dimon are saying, yeah, it's going to add to GDP, et cetera. Do you, of course. So do you see that the case? That's a more longer-term bullish trend.
Listen, here's the thing. I believe that tax cuts do work, okay?
Right.
And so, yes, I see it as a case. But if you had Austin Goolsbee on this show, right? Remember the former Obama economist? Good guy, very smart guy. He would say this. He'd say, listen, here's the bear scenario. We see deficits widening out. We don't see GDP growing to where the Republicans and maybe the Atlanta Fed says the 4 or 5%. On top of that, we see Trump as a protectionist. That's always bad for inflation, and it's bad for the economy. So we see rising inflation. We see potentially a bigger deficit, and we don't see that much economic bang for the buck. Guess what? You know, that's a sell signal for the stock market. I'm just telling you, that's a view out there, and I'm not saying I ascribe to that because I think when you pump trillions of dollars, he took the corporate tax rate down from 35 to 21 with the carve outs, with the deductions.
But long before that, this market was soaring on the regulatory relief.
You got on top of that, you have massive regulatory relief. I just think that is stimulus that the market that will have to help corporate profits. Thus stocks.
So what do you make of the tug of war today? We've been all over the map today. We had almost broken even. Then we were down 350, now 236. So in these type of fast market conditions, I read into that a market trying to weigh, we get in, we get out.
We don't know.
And I think people miss that. You and I have covered these markets for many, many years, and I think that's the one thing that you have to at least be able to readily admit. Markets don't know immediately, but they get a gut in time.
Well, what it is they are imperfect in the short run,
right,
and they run more perfect long term. Now, what is long term? At some point, the market's going to figure out what's going on. There's going to input all this data,
right,
and it's going to come out with something, and we don't know yet. And that's the problem with telling people what to do. My point is that, you know, it's in a sorting out situation, and you're not a trader. This is a great, if you want to trade stocks, this is the perfect time.
But would you be happy if we close? We're now looking at about a 5% correction from our highs, which this market hasn't seen in years, right? So we see that at the end of the day. Some would flip that around. So that's a healthy development.
I don't have a problem with
really?
it because we're off massive highs, and not only that, the market is digesting the news. We don't know how this is all.
So how do you advise? I know you don't deal with people who are worth less than 100 million, but do you subscribe to the view that those who dollar cost average put the same amount in the market every month or quarter, whatever? Do you subscribe that that is longer term the trend to take?
Yeah, I wouldn't right now be putting my money, you know, fresh cash in this until we figure out. Yeah, because I think this is clearly
you could buy more shares of stock.
This is the random walk down Wall Street.
Yeah.
I mean, you don't know where it's going, and at some point there's gonna be something's gonna develop, either the bear scenario or the bull scenario. I happen to think it's going to be good because I think when you cut trillions of dollars in taxes, that's a good thing. But